In the year 2023, the stock market, especially the tech sector, has been a roller coaster of emotions for investors. This video sets out to unravel the underlying reasons behind the recent turbulence in the market and to shed light on what the future might have in store. In this video, we will delve into the intricacies of the factors that have contributed to this market upheaval. To understand the current state of the stock market, it's essential to take a brief trip down memory lane spanning the last 5 years. This period can be neatly divided into distinct phases, each with its unique characteristics. It began with the pandemic-induced sharp and brief market decline, followed by a remarkable recovery phase. This recovery was particularly evident in the performance of the Nasdaq index, which dominated the market landscape. However, as 2021 drew to a close, the rally came to a sudden and unexpected halt, signifying the end of the tech rally. This stagnation transformed into a period of difficulty for tech stocks in 2022, aptly termed the tech wreck. As the year 2023 commenced, it seemed to mark the return of the tech bubble, albeit with a slightly different narrative. This time, the focus was on mega-cap US tech stocks and the narrative of artificial intelligence which took center stage. Zooming in on the events of 2023, we observe a sharp and recent turnaround in the market. This rapid shift raises the all-important question: are we witnessing a rerun of the 2022 tech wreck, or is this merely a temporary pause before the tech rally resumes its upward trajectory? One of the key drivers behind the recent market rally has been the tech sector. The Nasdaq 100 tracker, which encapsulates this sector, is primarily composed of US tech stocks. It's these tech stocks that have been at the forefront of driving the market's recent gains. When we closely examine the 8 largest companies within the Nasdaq 100, a striking revelation emerges. These companies collectively represent a substantial 43% of the index's total value and have contributed significantly, accounting for 22% of the recent rally. Tech companies continue to demonstrate their prowess in innovation, driving growth and maintaining strong consumer demand for their products and services. Their global expansion efforts are opening new revenue streams, and history has shown that markets can exhibit resilience, often bouncing back from setbacks. A fundamental principle of stock markets is that they are primarily driven by the prospect of increasing company profits over the long term. Investors allocate their capital to stocks with the expectation that these companies will generate more earnings in the future, thereby increasing the value of their investments. However, there are periods when market sentiment and enthusiasm can lead investors to pay a premium for anticipated future profits. This exuberance often results in a surge in valuations, where stock prices may disconnect from the underlying fundamentals. What becomes apparent is that there have been 2 consecutive quarters where year-on-year profits have actually declined. These quarters are Q4 of 2022 and Q1 of 2023. Additionally, the forecast for the current earnings season, Q2 of 2023, indicates a year-on-year profit decrease of nearly 6%. This sequence paints a concerning picture of 3 successive quarters witnessing falling corporate profits within the US stock market. In normal circumstances, this trend would often translate into a bearish sentiment in the market, leading to lower stock prices. However, 2023 has defied this convention by experiencing a substantial market rally despite these deteriorating earnings figures. This divergence raises a critical question: can this rally be sustained without a corresponding improvement in corporate profitability? It's a challenging scenario that investors and market observers are closely monitoring. Another factor contributing to this complex equation is how markets are interpreting inflation. At first glance, it may seem that investors are treating inflation as a problem that has been resolved or subdued. However, a closer look at core inflation, the metric that central banks carefully track, tells a different story. Core inflation, which excludes volatile factors like energy and food prices, has not seen a substantial drop. While the headline inflation rate in the US may be falling swiftly, primarily due to year-on-year declines in energy prices, the underlying and more persistent issue of core inflation remains a concern. This distinction between headline and core inflation is essential because it reflects the sustainability of lower prices in various sectors of the economy. The fact that core inflation hasn't fallen significantly indicates that broader pricing pressures persist, which could potentially affect both consumer behavior and corporate decision-making. This, in turn, has implications for market sentiment and performance. The intricacies of inflation and its impact on the market cannot be understated. The widely discussed base effect occurs when we compare current prices with those from a year ago, potentially skewing perceptions. However, when we strip out the volatile components of inflation, which are primarily energy and food prices, we arrive at what's known as core inflation. The noteworthy aspect here is that core inflation is decreasing at a much slower rate. This slower decline is driven by wage growth and the services sector, both of which are still displaying robust performance in the United States. Low unemployment rates and steady wage growth persist, indicating that core inflation is unlikely to subside quickly unless there's a noticeable deceleration in wage growth, which presents another challenge for the market. A crucial factor contributing to concerns about the falling stock market in the US is the current state of valuations. Despite the clear decline in profits for the S&P 500, stock prices have continued their upward trajectory. In essence, investors appear to be paying more for companies with declining profits. This phenomenon is often described as a re-rating rally, primarily driven by market euphoria rather than fundamental factors. While re-rating rallies can persist for extended periods, it's essential to acknowledge that historical patterns suggest that returns over the following 5 or 10 years after periods of exceptionally high valuations tend to be more subdued. Investors who are aware of this historical trend may start to reconsider their exposure to the stock market as valuations become stretched. The correction typically unfolds in one of two ways. Either corporate profits increase to justify the prevailing prices, or stock prices adjust downward to align with the levels that profits suggest they should be. This latter scenario is known as de-rating and often follows a significant re-rating rally. Looking ahead, analysts are optimistic about corporate earnings growth. While Q3 of this year may only see a modest 0.2% year-on-year earnings growth, forecasts beyond that point are bullish. Analysts anticipate earnings growth exceeding 7% and eventually surpassing 12% in Q2 and Q3 of 2024. Since markets are forward-looking, this anticipated earnings growth could provide a substantial boost to U.S. stocks and make valuations appear less extreme. Lastly, the United States continues to dominate the global tech landscape. The majority of the top companies in indices focused on areas like robotics, artificial intelligence, and technology are based in the United States. These tech giants, including Nvidia, Meta, Apple, and Netflix, hold a commanding presence in our daily lives, with no large global substitutes in sight. This first-mover advantage ensures that these companies continue to reap significant profits, potentially propelling their share prices even higher. If you found this video insightful, don't forget to show your support by liking the video and subscribing to our channel. Also, feel free to share your thoughts in the comments section below.